And that's the way I'm looking at the reaction, a negative reaction to this, to anything that happens with this the yes vote on healthcare. That it's a pullback that needs to be bought. The question is where. Okay, so there are the three levels. 1140. It'd be remarkable if it came down to 1140 and held, and just took off again. So I figured that the more likely place is 1155 to 1150, and then if things really get sort of acutely negative, I think we can go to about 1080, and that will be the next buy spot. So where is the risk other than equities this week? Well, the risk is here, is in the dollar, which started to lift last Tuesday and or Wednesday, Thursday, and Friday. And the dollar looks like it started a new up leg. So if equities come down, it's not an if then. My sense is that the dollar is definitely going up. Now, why would the dollar go up? Why would the dollar go up if the healthcare plan, the negativity of the healthcare plan, is creating selling in equities? Well, the dollar will be going up because people still think, investors still think, it's not a dollar-based issue. It's Europe. Europe's a mess. Europe doesn't know whether it will help Greece and not make Greece suffer so much in the process, or will it be France and Germany battling it out and at each other's throat, refusing to help, or one refusing to help and another not, one willing to help, and will that make Europe go towards the IMF, which the United States backs? So that would just be another commitment, responsibility of the United States. All right, well, you can see that it looks like off of its rising 50-day exponential MA, the dollar index took off. This turned out to be a beautiful channel, and the dollar looks like it's headed higher. Probably, if it meets its objective, somewhere around 82.5, 83 on the dollar index. Now, let's see where that fits in a larger picture. So let's condense it. You always have to condense these pictures and see where the longer term or intermediate term trend, where it was or is in relation to the near term trend. So this is an enormous decline in 2009. So as the equity market took off in 2009, people became less risk averse. The dollar came down because the prior year everybody was more risk averse and they were buying dollars for safety. Now, with the passage of the healthcare plan, why would anybody buy dollars for safety? Okay, the plan just makes our finances that much more complicated. So the dollar buying is for some other reason. I don't know what that reason is. It could be pure and simply that Europe is a mess and that there's a flight to dollars as a result. Okay, but anyway, let's see where this takes us. So we'll put a Fibonacci retracement on here, and the 50% retracement for the 2009 dollar decline comes in at 81.90 roughly, 8200. I think it can go higher than that, but you can see this is the dominant trend and this is a recovery. Now, tomorrow, if the dollar opens much lower and takes out Friday's or this week's lows, let's call it 79.40.50, and you end up going here, that's the end of the road for the dollar. I think the dollar could really have a problem if that happens. But based on what happened last week, it looks like the opposite will happen and it'll go straight up. So the dollar's going up. Equities, I don't know how they relate to the dollar, but I know equities look like they want to pull back a bit. And if they do, then I think it'll be a buying opportunity into the end of the quarter, which is in 10 days or 8 trading days, because lots of fund managers, I think, are underinvested and need to get in, and they're going to do it before the end of the quarter. So I think pullback in the equity market will be cushioned by the desire to buy equities into the end of the quarter. If for whatever reason, if the equity market opens up higher tonight, well, we'll have to see. If it takes out Friday's highs or Thursday's highs from last week, then it's off to the races. And I think the S&P goes to 1,200 before it even pulls back. But this picture right here, the dollar is another story. And I think the dollar looks near-term bullish. Well, what does that implicate or imply about other markets? Well, for starters, it would seem that the commodity markets would be the first to have a problem. And we discussed this, the DBC, the Deutsche Bank Commodity Index ETF last week. And it still looks like it's holding by a thread here in this area between 23 and let's say 24. My sense is that if the dollar continues to go up, this is more than likely to go down, and the DBC, which is composed of metals, industrial metals, copper, aluminum, gold also is in there, silver's in there, as well as energy. So you can see that if the dollar has an impact on the commodity side, and that there's no differentiation between why the dollar is going up, and that's because Europe is going down. It's not a dollar. No one wants to buy dollars. They're just getting out of euros. Maybe the commodity sector will hold up, and it won't be a one-for-one relationship or an inverse relationship. I don't know, but historically, the dollar strength has implied commodity weakness, and so the objective for the DBC, the Deutsche Bank Commodity Index, would be ETF would be a break of say 2310, 2308 would send you down to 22, and that would be the next buying opportunity amidst a somewhat suspicious uptrend. Now you can see this chart looks more corrective on the upside than otherwise, and so we need to be very careful with the commodity index. So what does that say about the commodity sector? Well, let's take a look at some names that are based on commodities, right? So let's take a look at FCX, Freeport-McMoRan. Okay, mostly a copper producer, but gold as well. It's been in a big uptrend since last year. We can see it in the condensed version. This is the December low, and it's had an enormous run. It looks to me as though it has rolled over, and from a lower high, this is the January high, it rolled over last week, and I think it will seek lower levels. Where? Well, the 200-day exponential and the major trend line is at 70. So we're talking about 10%, a 10% down move in FCX if things really get going on, really based on the dollar. A shallower objective would be against the February downtrend. The February support line, which is at 74. So we need to watch FCX closely, but it looks like it could be a victim, so to speak, of the dollar strength. Let's take another one. Let's take X. X2. X also looks like it's peaked, or I should say stalled at its prior highs. So it got up to 66 and change, and it peaked at 63.